Hey guys, it's Grant Miller from Inspired Financial Planners here. Sorry for the delay on this one. Meant to start at 12:30. It's now 1 o'clock. Had some technical issues, but hopefully everyone's able to still get something out of this one. And if you missed it, I apologize. Let me know. A lot of people have asked for a copy of the recording, so I'll send it to you as well. All right, so let's jump into this. I don't want to take ages. I hate those hour-long webinars and stuff, so this is not going to be even close to that. Just want to run you through basically what to expect from this. So going to be focusing on just keeping this simple, no BS, no fluff, no salesy stuff. Basically, let's just get stuck into what you need to know about HECS. I'm not going to read every point on every slide, but really important thing is all the disclaimers and licensing. So basically, this is all just general information. There's nothing tailored to anyone's circumstances, so don't take it as such. And I'd encourage you to get advice before doing anything after everything we've gone through with the HECS-HELP stuff. So what is a HECS-HELP debt? A lot of people just refer to it as a HECS debt. That's what it used to be known as. These days, it's known as a HELP debt or Higher Education Loan Program debt. Basically, it's something where the government says, you can go and study, we'll pay for it for you, and you just pay us back later when you're earning over a certain amount. That's essentially how it works. There's no special interest charges. Yes, the amount will increase over time, but that's not necessarily interest like you would get on a loan. That's purely keeping up with the cost of living. So when you hear about CPI and inflation indexation, that's essentially what we're referring to. Is a dollar now is not necessarily going to be worth exactly $1 in a year's time, which we very heavily recognize at the moment, where inflation's gone pretty crazy. So I want that to be very clear. It's not necessarily a penalty. It's just that the government has lent you money, and the true value of that dollar needs to be kept back on the government. Otherwise, they're spending more than they're lending out, kind of thing. And that's just going to result in more taxes and not good for anyone. All right, so to figure out how much you're going to owe, you need to log into your ATO portal. So to do that, you need to go to your MyGov account, link it to the ATO. If you have done that already, on the homepage, you'll see there's a tax section, then drop down to accounts, and then through to loan accounts. When you do that, you'll see this little section here, except it won't be grayed out with the amount owing. If you click on the blue text, that'll actually show you your transaction history, how much has been repaid, what the interest charges and all that sort of stuff were. So that's really helpful info to get some background as well. Now, how the increase is calculated. So I mentioned before, it's kept up with indexation. So one thing to keep note of, though, is that the indexation is actually applied on the 1st of June every year. This is really important to know because even though if you're an employee and your employer is regularly withholding extra amounts as extra tax, that doesn't actually go onto the loan at the time it's withheld. Same with your super payments and all that. They're only required to make super payments quarterly. So even though it shows on your payslip the tax is withheld or the super is withheld, for example, that's not necessarily going direct onto your bill at that time. So I'll go into more of that, but basically keep in mind for every $1,000 you owe, you're going to be paying an extra $71 in interest, and that's applied at the 1st of June, where that is going to be calculated. So how much has it been in the past? You can see here that 7.1% is quite an abnormal amount based on the last 10 years. The RBA likes to keep it sitting between 2 and 3%. We've had a lot of interesting times. So 7.1% is definitely outside the norm, but expect it to be anywhere from 2 to 3%. I would say expect it to be 3%, just because I'd rather be higher than lower in terms of expectations. All right, so how much do you need to pay? It's based on your repayment income. This is essentially, this text over here is copy and pasted straight from the ATO. Essentially, it's your taxable income. So that's your gross income that you receive less any allowable deductions. But if you have investment losses, that doesn't actually reduce the amount that you are required to pay for your HECS debt. If you have fringe benefits, so any kind of extra benefits your employer provides, like car, phone, electronics, anything like that, unless it's exempt. So that might be the case if you're working for government or charity or charitable organizations. If you're making extra contributions, that also doesn't reduce the amount that the ATO is going to calculate your repayments on. Okay. Now, the amount that's calculated based on that repayment income depends on how much you earn. So again, we're not looking at taxable income, all that sort of stuff. It's its own special formula. But Use this table again on the ATO website. If you want a link, let me know. Based on this, the percentage that you pay on the total repayment income. So this is how it differs to normal tax rates. So normal tax rates, you got the first 18,200 is tax free, then up to 45,000 is 19%, and it's tiered basically. So it's only on that chunk that you pay that specific rate. However, with your HECS debt, it's going to apply to your entire repayment income. So it's very different to your taxable income. So if, for example, you're between 79,207 and 83,958, then you're going to pay 5% on that total amount, not anything between the 48,361 and that amount. It's the full amount. Really important to know that because that's going to help you understand how much you're actually going to be paying in total. All right, so how do you make repayments? As I mentioned before, if you're an employee, it's likely your employer is already withholding additional tax for your HECS-HELP debt. That's assuming you've notified them that you have that debt on your tax file number declaration. If you haven't done that, you're going to get a nasty surprise when you do your tax return because that extra tax wouldn't have been withheld. Keep in mind as well, if your income fluctuates or there's any variables at all, then the actual amount withheld by your employer may be higher or lower. So you may end up with an extra tax refund, or you may actually have some extra tax and help repayments on top of what's already been withheld. If you're self-employed and you're not an employee of your own company, then essentially, when you lodge a tax return, that's when you're going to find out how much you have to pay as your repayment income. However, along the way, you can make voluntary repayments as well. So you'll notice before when we went MyGov, ATO, and then down to the debt, all that stuff before, you saw this screen before. There's a button here for voluntary repayment. So you can actually just make your own extra repayments along the way if you want to, whether you're employed or not. And that's really important to know because, like I said before, the amount that is increased, the indexation applies on the 1st of June. When you're lodging your tax return in July onwards, that increase has already happened. So if you want to make extra repayments and reduce the debt, reduce the amount that indexation is being added onto it, you got to go here and you got to make an extra repayment beforehand. All right. I just explained this before as well. So it's 1st of June. As I mentioned, interest is added before you lodge your tax return. So as I mentioned earlier, your employer may be withholding extra tax. And then when you lodge your tax return, that's when it's determined how much your repayment amount is. And therefore, when everything's lodged, your tax gets paid to the ATO in full. The amount that gets paid onto your HECS debt then goes to that. And then if there's any surplus, that goes to you, or if there's a deficit, then you'll get an invoice, which is never fun. All right, so I've got a few examples here on what the impact is of your HELP debt. Excuse the lack of creativity. We've got Bob and Bobby that we're doing examples for. So in both of these examples, we've got a starting HELP balance of 25,000. Indexation is 7.1%, which is reality this year. So based on that, there's going to be 1,775 added to the debt this year, which means the new total balance is going to be 26,775, assuming that no additional repayments are made before then. All right, so if we're assuming that Bob is earning $95,000 a year, his rate is going to be 6.5%. Remember that table we saw earlier, which shows your repayment income, the percentage that's going to be withheld? It means there's going to be an extra $6,175 withheld throughout the year, needed to be withheld, or at least owing when his tax return is lodged. All right, here we go. I added that and forgot about it. So that's where he sits, 6.5%. All right, so after that repayment is made, assuming he made no repayments along the way, no voluntary repayments, the end balance is going to be $20,600. So it's $4,400 less than it was, but this is despite making $6,175 in repayments. So we can see there's a pretty decent chunk there that is made up in interest for this year because interest rates or the indexation rate's so high. Now, if we've got Bobby and he makes an extra repayment of $5,000 and he does this before the 1st of June, remember the indexation is applied on 1st of June. So he's got to have this process in there before then. So new balance that the indexation is going to be applied to is just 20,000. That now makes it 1420. Total balance now is 21,420. Now, if Bobby did this, we've got the same thing, same repayment income because that's just based on what his income is. But the balance now is going to be 15,245. So it's making a bit of a difference here by doing that. So with the current situation, if we go savings versus debt, right? Um, and we're looking at that 5,000 that Bobby decided to do. If he's sitting that money in a savings account earning 4%, then he's going to be earning $200, but because of his tax rate, $82 of that is going to be paid in tax. So the actual amount of interest that he's earning, because that $82 is just going to get added when he lodges his tax return, in terms of his taxable income, it's not even $200 that he's going to be earning. So not a great deal. However, if he had that to reduce his HELP loan, then the interest saved, which is different to interest earned, $355. So pretty big difference. All right, $237 to be exact. So it makes a bit of a difference to clear that debt and save the interest instead of try and earn the interest and pay tax on it. All right, if you have a home loan and if you've got money sitting in an offset account instead, and let's say your home loan rate's 6.5%, then it's going to be $325 that you would save on home loan interest, which again is $30 less than you'd be getting on your HELP loan for this year. All right, so in terms of pros and cons of making these repayments, the major one is, I mean, really there's two. One is that you don't have the stress of having that HELP loan anymore. And two is that once it's cleared, then you have that over $6,000 in this example. Instead of that going towards tax and paying off a debt, that is now going into your bank account. So that's $6,000 more that you are going to have each year, which you can now start to invest or do any other number of things. If you wanted to just say, hey, I'm going to reward myself this year and take some of that money and do something for yourself, you can, instead of it purely just going on to clearing a debt. Cons is that if you do decide to clear the debt, money's gone. And once that rate goes down from 7.1 to say 5, 3% or whatever it is, then you may potentially be better off. Say if you've got an offset account and your rate's higher, that might be better than having it sit against the loan. But again, a major thing here is cash flow as well. So that's over $6,000 a year that you could be earning instead. All right. So Bob versus Barry. Final debt is $20,600 for Bob. Bobby is $15,245. So Bobby saved $355 in interest based on the indexation. So working that out, that's almost one full working day before tax. But considering this is basically like an extra tax, your regular income tax is irrelevant to this. It's actually more than one full working day that you are now working to pay yourself completely instead of paying off a debt. So that's massive. If you think about your entire working day next Monday, think about that as your full day just spent to pay this debt that looms. Whereas when that debt is gone, that's a full day just to pay you. Makes a really big difference. So I haven't provided it in these slides, but I can do this separately if anyone wants to see it. But assuming we've got 7.1% this year and then 5% and then 3% indexation year on year after that, the difference between the two is Bob's going to have his debt cleared in 5 years based on these indexation and he's not making any extra repayments. And Bobby's going to have his in 3 years. In both of these cases, in the 5th year and the 3rd year, there's actually a surplus. In terms of with Bob, he's still making, well, he's not making any voluntary repayments throughout the entire time, but Bobby only has to make those voluntary repayments in the first couple of years. In the 3rd year, he doesn't have to make any. Even with the indexation of, I've assumed 3% in that year 3, he's still going to now have a surplus. The debt's going to be cleared and he's going to get a tax return with the difference. So it makes a huge difference if you're able to make extra repayments. So big things with Bobby is he's now cleared up over $6,000 that was otherwise going towards repayments on his HELP loan. Bob's still having that over $6,000 taken out per year. However, on the flip side, Bobby's saved $5,000 a year to allocate specifically to the debt. So he's put more money onto the debt sooner, but now he's free of that debt, greater cash flow sooner than later. Really hope that was helpful. Like I said, just wanted to keep it really succinct here. But if you do have any questions or I didn't answer anything here, then please reach out, let me know. Scan the QR code here. That'll book in a time to have a chat over the phone. Otherwise, jump on the website inspiredfinancialplanners.com.au, or if you're Not so keen to type all that in. You can just go inspiredfp.com.au as well. Best thing you could do is jump on the website, complete the Financial Wellness Questionnaire. It's going to have a really good understanding for you and for me to basically assess where you're at in the 8 different areas of your financial life. So debt, HECS-HELP loan, basically one small part of the big picture. Cash flow, superannuation, investment, protecting your income, all that sort of stuff is going to be really crucial to your overall financial well-being. Like I said, HECS-HELP is just one small piece of the puzzle. So book in for a chat using this one. I'll probably redirect you anyway afterwards to complete the questionnaire because it's really insightful. But if you want to just have a chat first, that's totally fine as well. But yeah, encourage you 100% to do the Financial Wellness Questionnaire because I'll send you a report based on your responses as well. And then you can take with that and do with it as you will. Awesome, guys. Thanks for your time. Hope you're well. Cheers.